You've probably heard the same story again and again. Someone jumps into crypto, buys a few trending coins, dreams of overnight wealth, and ends up losing everything. The truth is, 90% of crypto investors fail. Not because crypto is a scam, not because the market is rigged, but because they play the game without understanding the rules. Today we're going to talk about why most people lose in crypto and how you can be in the 10% who actually win. Let's start with the hard truth. Most new investors chase hype. They buy coins when everyone's talking about them, when prices are already exploding. It feels exciting, it feels safe because everyone else is doing it. But by the time you hear about a coin on social media, it's already too late. Smart money has already taken positions months earlier. They're waiting for retail investors to rush in, to pump the price higher, so they can quietly exit with profits. That's the first reason most people fail. They follow emotions, not data. Successful investors understand that the real money is made in silence. It's made in research, patience, and positioning early. They spend time learning about blockchain technology, studying tokenomics, reading white papers, understanding real-world use cases. They treat crypto like a business, not a lottery ticket. And because of that mindset, they get in when everyone else is distracted, and get out before the crowd even realizes what's happening. Now let's talk about the second big reason people fail: lack of risk management. Everyone wants to double their money fast. They go all in on one project, one meme coin, one guaranteed gem. And when that project crashes, they lose it all. Professional investors never risk everything on one play. They diversify. They think in probabilities, not predictions. They use stop losses, take profits regularly, and never invest more than they can afford to lose. In crypto, risk management isn't optional. It's survival. The third reason is unrealistic expectations. People enter the crypto market thinking they'll turn $100 into $1 million overnight. They forget that even Bitcoin, the king of crypto, took over a decade to grow into what it is today. Real wealth takes time. It takes patience, discipline, and consistency. The people who get rich in crypto aren't the ones chasing every new token. They're the ones who buy solid projects, hold through the noise, and build conviction over time. Let's talk about something even deeper: psychology. Crypto isn't just about charts and prices. It's about emotions: fear, greed, hope, and regret. The market plays with your mind every single day. When prices rise, you feel unstoppable. When prices fall, you panic. That emotional roller coaster destroys most investors. They buy high, they sell low, and repeat the cycle over and over. Winning in crypto means mastering yourself first. You can't control the market, but you can control your reactions. Now, here's a harsh truth most people don't want to hear. If you're checking your portfolio 10 times a day, you're not investing, you're gambling. Long-term investors don't need to stare at charts every hour. They have a plan, they have a strategy, and they stick to it. They use bear markets to accumulate quality assets. They see fear as opportunity. They use bull markets to take profits, while others are blinded by greed. That's the mindset difference between amateurs and pros. Another key reason most investors fail is the lack of education. They rely on influencers, random Telegram groups, and rumors. They skip the fundamentals. In crypto, knowledge is your armor. Learn how blockchain actually works. Understand what makes a project valuable. Study the team, the supply distribution, the ecosystem growth, and the token utility. Don't buy something just because it's trending. Buy because you understand it deeply and believe in its long-term vision. Let's break down how you can beat the odds and join the top 10%. First, build your foundation. Start by learning, not trading. Watch how markets behave. Study price cycles. Notice how narratives shift over time. Second, diversify intelligently. Mix long-term blue-chip assets like Bitcoin, Ethereum, or Solana with a few high-potential smaller projects. That way, even if one project fails, your portfolio stays strong. Third, set clear goals. Don't just say, "I want to get rich." Define your targets. How much are you investing? What's your time horizon? When will you take profits? Having a clear plan keeps you disciplined and protects you from emotional decisions. Fourth, automate your investments. Use dollar-cost averaging to remove emotion from the process. Whether the market goes up or down, you're steadily building your position over time. And finally, control your environment. Stop following every hype account that screams next 100x gem. Surround yourself with data-driven investors, people who talk about fundamentals, not fantasies. The more noise you remove, the more clarity you'll gain. Remember, the goal isn't to win every trade, it's to stay in the game long enough to win big. Now, let's go a little deeper. The crypto market moves in cycles, just like every other financial market. There are accumulation phases, breakout phases, euphoria, and then despair. If you can recognize these stages early, you can position yourself perfectly. Most people buy during euphoria, when headlines are screaming, "Bitcoin to the moon." But the real pros? They buy during despair, when the market is quiet, when everyone else has given up. That's where the real wealth is created. Let's use an example. In 2018, Bitcoin crashed from $20,000 to under $4,000. The world called it dead. The media mocked it. But the smart investors were silently accumulating. 2 years later, those same investors saw 10 to 15 times returns. History repeats itself again and again. If you learn to recognize these patterns, you'll never fear market crashes again. You'll welcome them. And here's another lesson. Don't ignore utility. The projects that survive aren't the ones with flashy marketing. They're the ones solving real problems. Ethereum gave us smart contracts. Chainlink connected blockchains with real-world data. Solana scaled speed and efficiency. These are technologies with staying power. Always ask, what real value does this project bring? That single question can save you from 90% of bad investments. The last reason most investors fail is this. They quit too soon. They lose once, they panic, and they walk away thinking crypto doesn't work. But in reality, failure is just part of the learning curve. Every successful investor you admire has made mistakes. The difference is, they learned from them. They adjusted, they improved, and they kept going. If you can do that, success is inevitable. So here's the bottom line. The reason 90% of investors fail is because they treat crypto like a get-rich-quick scheme. The reason the other 10% succeed is because they treat it like a long-term game of skill, patience, and knowledge. The market rewards discipline, not emotion. It rewards strategy, not luck. If you want to beat the 90%, start acting like the 10%. Educate yourself, control your emotions, build a real strategy. Think long-term. Because when the next bull run comes, and it will, those who prepared will rise, while the rest will be left wondering what happened. And that's the truth most people never understand about crypto. It's not about predicting the next coin. It's about becoming the kind of investor who can survive any market. Once you master that, you'll never fear a crash again, because you'll know exactly how to turn it into your next big opportunity.